Hey, I'm Jonathan Lyons, and this is the Iverson Options Trading Forum Technical Analysis course. Okay, and this is going to be quick. It's going to take like 30 to 45 minutes. I'm going to make the information really simple, and it's going to be easy to digest. We'll go through a few different things regarding technical analysis and how it plays a role in your determining whether or not the price of a stock is going to go up or go down. All right. So right now, what I have on the screen is the disclaimer. Please read over it. I'll give you a few more seconds to read over that disclaimer, and then we'll get started. All right. So now on to technical analysis. I want to do a really quick overview on options trading. I mean, if you're in this group, then you already know that this is, based around options trading. You may not know exactly how options trading works, so I want to give it to you in the simplest terms. All right. So options trading is when you are placing bets essentially on whether or not you think the price of a stock is going up or going down in a period of time. Okay, so when you purchase an options contract, it's going to come with a few things. And I'm going to give you an example really quickly to help us break this down, a little visual aid, if you will. So let's take a look. Blow this up for you guys. Okay, so this really cool demonstration of naked call options, naked put options, which is what you'll be doing, which is the really simplistic stuff when it comes to options trading. This is really easy. So, all right, so when it comes to options, there's a buyer and there's a seller, okay? And then, so this is you, and you got the guy you're betting against, and you got your stock option, that's the actual contract itself, okay? Now you got a price. This is called a strike price. It says set price here, but it's literally called a strike price. So you got a strike price. That's what you think the price should go to or head towards. All right. Then you got an expiration date, and that's how long you think it'll take for the stock to make that move. Okay. And if you have a closer expiration date, then, it's a much riskier trade, but you also gain a greater amount of funds if it moves in the direction that you're looking for. But if you get a further away expiration date, then there's less risk involved, although there's less return on investment involved. All right. So you weigh those options out as you see fit. But there's a strike price and there's an expiration date. And then there's two types of options. Okay. There's a call option, which is basically a bet that the price is going to rise, and that's represented here. So as the stock price rises, the value of your option rises, you make money. If the stock price decreases, then that lowers the value of the option and you lose money. Okay. So that's how call options work. The inverse is true of put options. All right. As the stock price rises, you lose the value of the option contract. But if the price goes down, then it rises in value and you make money. So that's a really cool thing that differs from stocks, is that you can make money whether or not the price is going up or down. All right. So this is good stuff. All right. So those are options contracts explained really simply. And now let's talk about making those determinations about, when it will make its move and in what direction. So we do that by assessing charts. Okay. And you're looking at a chart right now, and I'm scrolling up so that you can look at some indicators as well. So your chart will be made of, indicators, various indicators, including candlesticks, et cetera, et cetera. And I'm going to break those down to you right now. All right. So let's start with the heart of this chart, which is these red and green bars. Okay, these are called candlesticks, and these candlesticks formulate patterns. And these patterns have happened millions and millions of times, billions of times over years and years and years and years, right? So they become somewhat of a self-fulfilling prophecy. People look to see these patterns occur, and then those patterns give them faith that, there will be a continuation or a reversal of a pattern, of a trend, of a movement of the stock. Okay, so I'm going to show you a few of the candlestick patterns that I find most helpful. I really only use 4 candlestick patterns. There's a wealth of candlestick patterns out there. If you're going to follow this strategy, then we're going to discuss the 4 that I actually use. And so let me show you what those are. So we'll start off with the bearish pin bar. Or as a matter of fact, let's start off with candlesticks. Let's break down candlesticks and give you guys exactly what those are. Okay, here we go. All right, the bullish candlestick. This is the green candlestick that you saw on the screen. All right, here's how it works. This is the open, okay? The bottom of the body of the candle is the open for the day. That's 9:30 in the morning. This is where the stock was at when the market opened. All right, it went up. That's what makes it a green candle. The price shot up. Wow, great day. And then it closed here. And this is the close. This is 4 o'clock when the market closes. This is where the stock was, okay? This black line that's coming from the body of the candle, this is called a wick. And the very top of it is the high of the day. All right, that's the highest point that the stock price went to today. All right, same thing here at the bottom. This is a wick. The very bottom is the low. All right, that's the lowest point that the stock went to today. Now, the same thing is happening on the bearish candlestick, just in the opposite direction. This is the open. All right, this is 9:30 in the morning. This is where this bad boy started. It was a bad day. Price goes down. This is where it closed. At 4 p.m., this is where the stock was. All right, so this is the open. This is the body of the candle. This is the close. Then you got your wick here. This is still the low of the day. This is the lowest point. You got your wick here. This is the high of the day. This is the highest point of the day. All right. So those are candlesticks. That's what you're looking at. Then you know exactly what's being explained to you when you take a look at a candlestick. All right. So that's really easy and simple to understand. Okay. And so now that we've taken a look at those, let's take a look at some of these patterns that they formulate and how those patterns help us to decide whether or not stock's going to be making a movement in a direction that we favor. All right, so let's start with the bearish pin bar. Right, this is the bearish pin bar, and I'm gonna blow it up a little bit so that it's easily read. All right, let's read it. The bearish pin bar is a specific candlestick pattern where the body of the candle is small. There is a little or no lower shadow. The upper shadow is relatively long and at least 2/3 of the range of the candle. All right. So here's the illustration that gives a visual aid to what was just read. All right. So this is the little bitty body, very small body. This is the very long wick. All right. And that's what you look for when you're looking for a bearish pin bar. Little to nobody, little to nobody, little to no lower shadow or lower wick, and then very long, 2 to 3 times the length of the body, the upper wick is. Okay, so that's it represented here, 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 and here. Okay, these are all bearish pin bars. I prefer to see them this way. Okay, but these are all bearish pin bars. I just like it when there's like some body to the candle. But yeah, they're all bearish pin bars. Okay, and so now let's talk about where you want to see these occur, because I mean, the pin bar could pop up anywhere on the chart, but not everywhere that it pops up, it matters. Okay, there's a time when it really matters, and here it is. Bearish pin bars should appear at the resistance of downtrends, okay, or at the top of uptrends. All right, so at the resistance of downtrends, that's a trend trade. You're following the trend. Okay, the stock is moving downward. It's reached a resistance level. Okay, so it shouldn't be able to go any higher. And you see this pin bar giving you an indication that the stock is going to go downward, and it does. Okay, it does. So that is a trend trade. Or you can see it at the top of an uptrend. So when the stock is moving upward, and then you catch this at the top of the uptrend where, you know, there should be a point basically where the stock should have to come down a bit before going back up. And that is considered a counter trend trade, a little bit more risky, but still doable. All right. So that's a bearish pin bar. You want to see some upward momentum happening, and then you spot this bearish pin bar. So you want the stock moving up, spot the bearish pin bar, you get that reversal. Okay, so now I want to provide a visual aid to help you guys see this right in front of you. So here's a chart, and here's a chart. I want to look at MA though, because I found a spot where it's clear there. I want you guys to see this. Okay, this is a MasterCard. This is a MasterCard chart, and here we are. Here we are. This green candle that has 356. This one. Here you go. Pin bar right here. Reversal pattern right here. It's happening. All right. It's got that very small body. It has that short upper wick, or lower wick rather. And then it has that upper wick that is, you know, 2, 3, 4 times the size of the body of the candle. All right. So this is it. This is what you're looking for. Okay. This is what it looks like on the chart. And you find it happening at the right spot, because here's that upward momentum that you're looking for. Here's the stock trending upward. You see the price of the stock rising. Price of the stock rises. You find that pin bar pattern here at the top, and then you've got the reversal that you were looking for, where the price goes down to 322 in a period of about a week, 325 in a couple of days. All right. And that's money. That's money. All right. Good money. All right. And if you get in this trade, get in a put option, betting that the price will go down, and it does, almost 30 points over a 2-3 day period. Okay. Your account is going to swell. Okay. It's going to be full of greenbacks, and you're going to be very happy that you took this course. All right. So there you go. There's the pin bar. All right. Now let's talk about the 3 other patterns that I find to be really reliable. Okay. So we talked about the bearish pin bar. Let's talk about the bullish pin bar now. And here it is. Blow it up some. Okay. The bullish pin bar is a specific candlestick pattern where the body of the candle is small. There is little or no upper shadow. The lower shadow is relatively long, and at least 2/3 of the range of the candle. Okay. So here's it illustrated. All right. Same thing as the bearish pin bar, just, you know, in the reverse. Okay. So you got that small body. You got that long lower wick. All right. You got no upper wick whatsoever. Same thing here, but with a small upper wick, and then look like almost nobody here with the wick, etc. Okay, so there it is for you visually. Now, in the same way, like with the bearish pin bar, there's a specific time that you want to see this. All right, and that is at the support of uptrends, then you're following the trend now, or at the bottom of downtrends. Okay, and that's a counter trend trade. So what we're looking for is to see momentum coming down. So seeing some red, we're seeing the price of the stock drop. It's dropping, it's dropping, it's dropping. It hits the bottom. All right, it hits this pin bar. This pin bar pops up, and now we believe that there's going to be a reversal. And just to give some information about why we believe there's going to be a reversal, so that there's some real understanding here. This wick indicates that the price attempted to go lower. It reached the low that it could, and then it was driven back up. All right, and because it was driven back up, we kind of think that the bears, the guys pushing the price down, they don't have control of the market anymore. All right, this is now a bull market, and they're going to push this stock up. All right, that's what we see when we see this pin bar. So if we see it at the bottom of some downward momentum, then there should be a reversal. Okay, so that's the bullish pin bar, and I'm going to show it to you on a chart. So here it is. It happens right here. All right, at this red bar, it says 280. Okay, this is it right here. And let's make note that when it comes to these pin bars, it doesn't matter if the bar is red or green. It just matters where it's placed. It matters if there's upward or downward momentum prior to you seeing it. All right. So this is it. This is the pin bar. Here it is. All right. We see the downward momentum happening. The price went from 354 at its high. The price goes down over a period of weeks to crash out at about 280. So, almost like 70 points that it dropped over a period of 2 weeks. Wow. And so, yeah, so you see that occur. Okay. You see that downward momentum occur, and then boom, you spot your pin bar, and then there's that reversal. The price is driven up, and you make loads of cash for your wallet and for your household, and you're happy about that. All right. So there's an example of that pin bar. Now let's talk about the final two that I actually utilize. Okay. So we've talked about the bearish pin bar. We talked about the bullish pin bar. Let's talk about the crow now. All right. This is the crow. All right. And the crow is a bearish reversal pattern. Okay. So that means that when you see it, you think that the price is going to be dropping. You want to see it after some upward momentum. It's a reversal pattern, bearish reversal pattern. So you want to see that upward momentum. Then you want to spot this, and that gives you indication that the price is headed downward. All right. So the one black crow consists of a bullish candle followed by a bearish candle. Now the bearish candle must open. It's got to open below the close of the bullish candle. So you spot this red candle. Now, let's say this as well. Unlike those pin bars where the colors didn't matter, colors are important with these next two, this black crow and this soldier that I'm going to show you next. Okay. You need to get the colors right. Okay. There needs to be upward momentum that ends in a green candle, followed by a red candle, and then that downward trend. All right, that reversal happens. Okay. So again, that bearish candle, that red candle, it's got to open below the close of the bullish candle, and it has to make a lower high. All right. So that's happening. All right. And the bearish candle must close below the low of the bullish candle. The bearish candle's got to close here below the low. This is the low of the bullish candle. This is the close the bearish candle. All right. And so we've seen that occur. We believe now that there's, a lot of pressure to drive the stock in the opposite direction. And so we get in and it happens for us and we make our money. All right. The one black crow should appear at the resistance of downtrends. All right. Or at the top of uptrends. All right. At the resistance of downtrends, it's the less risky trade. At the top of uptrends, there's a bit more risk involved. All right. So that's the one black crow. Now let's take a look at it on a chart so we know it when we see it. All right. All right. So here it is. This is our one black crow. It's occurring right here. All right. Here. Here. Okay, you see it? Okay, so here's the upward momentum. Got the upward momentum, and we've got our green candle here, followed by our red candle. And does it meet all of our qualifications? Let's make sure this is the open, and that open is below the close of the green candle. So that's one thing. All right. This is the high. It makes a lower high. So that's two. All right. This is the close of the bearish candle, and it closes below the low of the bullish candle. And so there you go. You got the crow. There it is. All right. Now you spotted the crow. Now this is your confirmation candle here right next to it. This is the price dropping significantly. This lets you know, okay, this is an official crow. I want to get in. You're in on this candle. The price drops all the way to, what, 312 if you stayed in the trade for about 2 weeks. So from about 350 to like 312 in a matter of a couple of weeks. All right. Lots of money in your account if you're in a put option after noticing this crow. Okay. So there you go. That's the crow. Now let's talk about the last one. Let's talk about the soldier. And I'll show you an example of it. All right. Here's the soldier. Same thing, just kind of like in the reverse. All right. So you get that downward momentum. This is a bullish reversal pattern, the one white soldier. So you're looking for downward momentum. You see the stock trending downward. All right. At the very bottom, you spot a bearish candle, and it's followed immediately by a bullish candle that engulfs it. All right. So the one white soldier consists of a bearish candle followed by a bullish candle. All right. You want to find that at the bottom of a downtrend, have that downward momentum. This is at the bottom. Okay. The bullish candle must open above the close of the bearish candle and make a higher low. Bullish candle must open above the close of the bearish candle and make a higher low. So here's the open, all right, of the bullish candle. Here's the close of the bearish candle, so it's higher. Okay. Here's the low. Here's the low. All right. So it's got a higher low. All right. The bullish candle must close above the high of the bearish candle. Here's the close. Here's the high. All right. So it's above it. All right. One white soldier. There you go. You got it. All right. So you see that. Now you know that the price is going to reverse. You're looking for the stock to start moving in an upward fashion. And I'll show it happening here on a chart. It's happened millions and millions and millions and millions of times, and it ain't going to stop happening. All right. And so here it is. This is it. This is what you're looking for. This is the soldier when you need him. All right. He's fighting in that war to grow your account. And he's right here. All right, here you go. You got the downward momentum taking place, quite a bit of downward momentum, the price dropping significantly. All right, here at the bottom, you spot this soldier. All right, you got bearish candle followed immediately by a bullish candle that makes all of the right highs, this higher than this, the the low is higher, it opens higher than the high of the candle. It's a one white soldier. So you get in on the trade. You probably wouldn't have got in the next day because the price dropped a little lower. But about 2 days later, the price began to rise. And just as a note, that's about how much time I give for confirmation. So if I spot a pattern happening and I don't get a confirmation immediately the next day, I may give it, about 3 days. So I give it 3 sessions. And if it hasn't happened by then I'm no longer interested in that pattern. But this did occur actually within the 3-day period. And so you caught the price rising. And so it went from that let's say 320-ish or so when you get in on the trade. And then the price rises up, goes as high as 368.79. So, a wealth of money into your account thanks to that one white soldier. He's pillaging the field and filling up your bank account with greenbacks. All right. So that's how that works. All right. Now, those are all 4 of the signals that I utilize. And now I've shown them all to you. And now I want to give you some information on how to utilize them in congruence with this next indicator. Okay. This next indicator is called the Bollinger Bands. Okay. And the Bollinger Bands are really important because they are a dynamic kind of support and resistance. And support and resistance is where we want to make our trades. Okay. Support and resistance is where we want to make our trades. Essentially, a support level is the point where a stock wants to reverse to the upside. Okay. So that means there's downward momentum. Trying to show you this here. There's this downward momentum. The stock reaches a place where it can essentially go no lower, or we believe that it won't go any lower, and that it's time to reverse. Well, when that happens, we call that place, that zone, that number, that number of price where it can't go any lower. We call that the support. We call that a support level. And when it reaches that support level, there should be a reversal. Okay. Also, there's resistance levels. Same concept, opposite direction. All right. So we think that there's a top where the stock can go no higher, a little zone, price area where we think the stock is going no higher than this area here. All right. So it reaches it. All right. And then it reverses. All right. It goes down because that's what stocks do. You'll notice that on all of the charts as you practice and you become more and more skilled, you'll see that these charts ebb and flow like the waves. All right. So up and down movement. And so that is support and resistance. And lots of traders, kind of map out their own support and resistance levels using lines to kind of like draw on the charts or whatever. But that's not how I find support and resistance, and that's not the strategy that I utilize. So I'm going to share the strategy that I utilize. I utilize these Bollinger Bands, which are this little red line that you find traveling on the outside of these candlesticks. All right. These are my Bollinger Bands, and they are a dynamic support and resistance. They travel along with the candlesticks, showing you places where reversals happen. If you just look at your chart, you can see so many places where the stock bounced off that Bollinger Band and then reversed. Happens here, happens here, happens up here. It's happened millions of places all throughout charts. So you just look and you'll see it happening over and over again. All right, so this is the Bollinger Band. And now I'm going to show it to you as a photograph just to kind of help with the visual aid. All right. So let's take a look at the Bollinger Band and how it works. All right. So I pretty much explained to you how it works following the candlesticks. working as resistance and support. And here's another example, okay? This is support down here at the bottom. This is resistance up here at the top, all right? So you got your support here at the bottom, support levels, resistance levels here at the top, and you just see the stock, you know, acting like waves, you know, ebbing and flowing, bouncing off of that support level, rising on up to resistance, bouncing off, coming back around, you know. And do note that this isn't like, you know, guaranteed. There isn't, you know, this isn't for sure that it's just going to stop the moment that it bounces off of the band. So keep that in mind. You know, it can bounce on the band for a while, travel along the band for a while before having that reversal. But, you know, it just lets you know, hey, this is coming up. All right. You see it here traveling along the band for quite a while before that actually reverses. But it does happen. And it's happened countless times. All right. So that's why I utilize the bands for support and resistance. I just find it to be easier, a lot less subjective than drawing on the charts. All right. So that's the Bollinger Bands, and that's how the Bollinger Bands work as an indicator. All right, so that's the first, you know, of many indicators that I'm going to show you here, or of a couple of indicators that I'm going to show you here on the chart. All right, so we've talked candlesticks, we've talked Bollinger Bands. Now let's talk about moving averages. Okay, so moving averages are basically average. They're basically the average of a price over a period of time. All right. And for us, we use the time span of 50 days, 100 days, 200 days. And the moving averages, the simple moving averages are represented by these blue, green, and pink lines. All right. And they don't have to be that color if you don't want them to be. But just so you know, the colors are located here up to your left in this corner. All right. This is your MA 50, MA 100, MA 200 Bollinger Bands. You know, that's why I love this site, stock charts, because they, you know, they give you this stuff in color and stuff. You can see it. All right. So there you go. So the moving averages, we use those to look for fans. I call it a moving average fan. I'm going to show it to you on the chart so that you have an example of it. Let's take a look. All right. Okay. So here is, I want it a little clearer than that. I want you to get it better. All right. Let's take a look at Apple. It's a little more clear on Apple. Okay. So this is what we look for. This is called a moving average fan. Okay. This line is the 50 moving average. That's the blue one. This is the 100 moving average. That's the green one. And this is the 200 moving average. Okay. And we look for a moving average fan. That means that the 50 is above the 100 and the 100 is above the 200. All right. And when we find this fan, that lets us know that there is an uptrend going on. All right. The stock is going upwards very strong. And you note that by looking at this Apple chart, the stock's going up, making those higher highs and those lower lows. So it's in an uptrend. It's in a period of an uptrend. And the moving averages confirm that to be the case. All right. It works the same way when you're looking for a downtrend as well. Okay, guys. It works the exact same way when you're looking for a downtrend. You'll be looking for the stock to be moving lower, making lower highs and lower lows. And you'll look for the moving averages to be in order, you know, but in the opposite direction. So on an uptrend, you want the 50 above the 100 above the 200. On a downtrend, you want the 200 above the 100 above the 50. All right. And when you spot that, you can feel confident about the trend that the stock is in. And for me personally, if I don't see the fan I just don't get in the trade. Okay. If there's no fan happening, then I don't want in the trade. I'm not as confident as I could be, and I want to just stay away from that. And I'd recommend that you do too. All right. So that's how the moving averages work. Okay. So now we've talked candlesticks, we've talked Bollinger Bands, we've talked moving averages and the moving average fan. Okay. So now let's scroll down and let's talk about stochastic. This is the full stochastic chart indicator. Okay. And this is like one of the most important ones to me. Okay. And it's really simple to understand. All right. It works as a reversal indicator, kind of lets you know when things are overbought or oversold. Okay. And if a stock is overbought, then obviously the price should be going down soon. You know, that's what we think. And if the price, if the stock is oversold, then we believe that the price is going to go up soon. All right. It's too low. It should go up some. All right. And the stochastics make that really easy to find out, because the way that it works is this: at 80 or greater, a price is presumed to be overbought. All right. So the price is too high when you catch it above 80. So you look over, you see 80, you see the price approaching 80 or up above 80, you note, okay, this price should be coming down soon. All right. And you'll see it happen on the charts in millions of places. Like, for example, take a look right here. All right. Go right down. You see the stock got up to a point of 124.99 while cascading on the, up here by the 80. And then you find that the price drops. Price of the stock drops. Price of the stock drops. All right. And it happens along with the full stochastic. All right. Another time you found the price super low down here by the 20. All right. And then what happens? The price shoots back up, makes that movement towards the 80, finds itself at the 80 here, and this 121 drops right back down, and then you see it happen in the stock. All right. So that's how that works. That's really simple, man. All right. Full stochastic works just like that. If you spot it above the 80, it's overbought. If you spot it below the 20, it's oversold, and you should look for a reversal. All right. You should look for a reversal to happen. So that's the stochastic. That's the full stochastic. Now let's talk about the MACD. Okay. The MACD, this is the MACD on your chart. All right. And I could explain it to you from here, but I've actually got a photo for you. And so let's take a look at these photos of the MAC. So we use the MAC in a few different ways, and I'm going to teach you all of the ways that the MAC can be used right now. So let's talk about it. All right. This is a picture of the MACD. I'm going to blow it up so that you guys get a good look at it. Okay. This is the MACD indicator here. And what you're looking at right now, what we're going to be talking about right now, is the MACD crossover strategy. Okay. So this blue line is the MACD line. Right? This blue line is the MACD line. The red line is the signal line. Okay. These red and green bars, this is a histogram. Okay. And we'll talk about the histogram in a second. So guys, I just want you guys to know what you're looking at. But now let's talk about the crossover. So the way that the crossover works is that when you see the MACD line, that blue line, crossing the signal line, then that's an indication of there being a reversal in trend. So you spot it happening right here. This blue line's coming up under the signal line, right? Breaks out, starts to go above the signal line. And if you look at the chart right above it, as the price is moving down, the MACD line and the signal line are both moving down. once that crossover happens, the price of the stock moves up along with that MACD line and that signal line. All right. Then you come here, you got the cross happening again, happens right here. The cross happens. It's moving down. The price of the stock is dropping. It's going down. Crossover goes on and it happens again. And then you see it move up along with the stock. All right. So you get what's going on here. It's really simple. You catch the blue line crossing, then you know that there's going to be a change of direction. All right. So that's how the MACD crossover works. All right. So that's one strategy for utilizing the MACD. Now let's talk about a different strategy. Let's talk about divergence, MACD divergence. So show you how that works. All right, MACD divergence. The word divergence, it means that, there's essentially some opposites happening. Like, this is diverging from that, they're going in opposite directions, essentially. Okay, so that's what happens when you spot MACD divergence. So the way that it works is that the price of a stock should be moving in one direction while the MACD is moving in the opposite direction. All right. So this is the bottom of the MACD. Here's the MACD signal line, that blue line. I mean, the MACD line, that blue line. All right. Here's the MACD. And it's moving in an upward direction towards the swing low right here. Okay. So this swing low on the MACD connects to this swing low on the MACD. All right. And that's how it has to work for there to be divergence. You have to connect two of the MACD swing lows without intersecting any price in between. So that does occur here. Okay. All right. And while that's happening, the MACD moving upward, there's divergence happening on the chart. All right. Because the chart is actually moving down when you connect these two swing lows. All right. That's what you want to do. You want to connect the swing low on the chart to the swing low on the MACD. All right. That should be essentially, above each other vertically. It doesn't have to be like exact, but it needs to be really close. All right. So they're right above each other vertically and they're moving in opposite directions. This one's going up while this one is going down. And when that happens, that's called divergence. And that is an indicator that there's about to be a reversal of the pattern. All right. So currently or of the trend. So currently there's a downward trend happening with the stock. But when you spot this divergence, then that lets you know that, it's going to move into an upward trend. The stock's going to start moving up. And it does. The price increases, the price drops up. There ends up being a MACD cross, which occurs here, and you just watch the price go up from there. All right, so that's the MACD. Those are two of the ways that you can use the MACD to your benefit. All right, so that's how that works. Those are two ways, and I want to show you this final way, and that's using the MACD histogram. Okay, and for that, I will go to the chart to allow you to see it. All right, so these bars are called a histogram. These are the MACD histogram. And the third way that you can use the MACD is by buying at the bottom or at the top of a MACD histogram, a set of bars on the MACD histogram. Okay, so I'll show you what I mean. Let's see. I want you to be able to see the chart and the histogram at the same time. So I guess this kind of works. Okay, here we go. For example, this is the bottom of the histogram here. See here, these yellow, orange, yellowish looking kind of bars here. You see that the bottom of the histogram happens, somewhere like, let's say around here, maybe the bottom of the histogram happens. And there's then there's this upward momentum on the histogram. So see, there's a slope. So you look for that slope. You see that slope happening here. All right. And if you get in at the bottom, right here, the price relative here, get in at the bottom of that slope, you catch that slope and you ride it up, you'll see that the price of the stock also moves up with that slope. All right. So that's how you make your money. Okay. Then you catch it again at the top here. Okay. And if you look, when you catch it at the top, the price of the stock moves down. So you caught it at the top here, and that slope occurred, and you rode it all the way down to the bottom. All right, where another slope occurs, and relative to the price of the stock, the price went up. All right, so that's how it works. You look for tops and you look for bottoms of the histogram, and those are reversal patterns. Okay, so we've talked about the crossover, we've talked about the histogram, and we've talked about divergence. So, okay, that's everything on the MACD. All right, so now let's go down to our last indicator. This is the Bollinger Bandwidth. And the Bollinger Bandwidth works in congruence with the Bollinger Bands, like a derivative of the Bollinger Bands. It is for determining breakouts. It helps you to see when the price is about to shoot out in a direction, whether that be up or down. And I've got a little aid here for you guys to take a look at. All right, so this is the Bollinger Band. And so what you look for, the Bollinger Bandwidth rather, and the Bollinger Band is up here on the chart. And what you look for is what's called the Bollinger Squeeze, okay? So that's when the Bollinger Bands squeeze together, are coming in together really closely. And when that happens, when they have that kind of squeeze occurring, then you should know that there's a possible breakout happening. Okay, there's a breakout about to take place. And you take a look at your Bollinger Bandwidth, what you'll see is an extreme decline in the bandwidth relative to the squeeze. So you look at the bands, they have squeezed together. Then you take a look at the bandwidth, you notice that it is extremely low relative to the other places that it's been, and boom, you note that there is going to be a breakout. On this chart, there was a breakout. It was to the, it was to the downside. All right. And boom, you get in, you make your money. Now, that's the thing about the Bollinger Bandwidth and the breakout. Using the breakout and the squeeze, it's not going to tell you which direction it's breaking out in. You've got to look at the candlesticks for that to see the way that it breaks out. But, when you find the Bollinger Bandwidth extremely low, that breakout has occurred if you couple that with that squeeze. All right. And then you see the Bollinger Band will rise as that squeeze is done. All right. So it doesn't matter whether the price of the stock went down or went up. The Bollinger Bandwidth is always going to go up. That just indicates that the squeeze part is over. Okay. So that's what you look for as a strategy with the Bollinger Bandwidth. On the opposite side of that, if the bands are far apart from one another, then that is a signal of volatility in the market. Okay, that just lets you know that there's a lot of volatility in the market right now. The prices are having huge swings, and so that lets you know that there isn't really. I don't really have a strategy for utilizing that, but that lets you know what you're looking at. I would say that if I note that there's a lot of volatility in a stock, then maybe sometimes that makes me a little leery to get into it. Obviously, I don't want to get on the wrong side of a very volatile stock that makes a crazy movement against me. So that might be something to look out for on the defensive. But as far as the squeeze goes, the Bollinger Squeeze, that strategy is great. And you use it just how I explained it, along with the Bollinger Bandwidth. All right, so that's that. All right, so we've gone through all of the indicators now, guys, and I've given you a breakdown on how to utilize them all. But now I want to talk about symmetry and how you utilize all of these indicators as a matter of symmetry to create a picture of where you think this stock is going to go. All right. None of these indicators work by themselves. They all need to be aligned with other indicators in order to give you the confidence that you're looking for. All right. So I want to show you all of these indicators working together in your favor. All right. Or lots of them working together in your favor anyway. Okay, so the chart that you're looking at now, this is big. This is Big Lots. Big Lots has been doing really good over the past few months. I mean, stocks are just growing exponentially, and I want to show you some places where this happens. So right here, right here, there's something happening. Can anybody tell me what's happening here? Well, if you said that there's a soldier pattern happening here, you would be absolutely right. All right. That soldier is happening right there. All right. Show you a picture of it again. Just talked about it. There it is. You got the red bar. You got the downward momentum. You got the red bar. You got it followed by the green bar. And that soldier is happening right here with with um with Big Lots. And when it occurs, you'll note that it occurs here where the stochastic is in oversold territory. All right, so that lines up perfectly. You got the pattern that lets you know that there'll be a reversal, and then you have the stochastic pointing to overbought territory, which indicates that there'll be oversold territory rather, which indicates that there'll be a reversal. You stroll on down here, right here. What do you got? You got a crossover. You got a MACD crossover happening too. So line it all up now. You got one white soldier pattern happening right here, bouncing off a Bollinger Band. Okay. We've got EMA, we got a simple moving average fan happening. All right. So you got your moving average fan happening, blue above the green, green above the pink. You got your soldier pattern happening right here at the support level, bouncing off that Bollinger Band. All right. You look down, the stock is oversold right now. There should be a reversal. All right. You look down a little bit more, you spot this wild MACD crossover happening at the same time. And then you've got the symmetry that you look for. You see everything's lining up perfectly now. So this is the trade that you want to take. And if you had taken that trade, then you ride the stock all the way up from the low 40s up to about 70. All right. And that's money in your account. That's big money for you. Okay. And that's what you look for when you make your trades. You look for this symmetry, this congruence, this confluence. You look for everything to line up perfectly to let you know, great, I want to be a part of this trade. So we saw it happen there. Let's take a look and see some other places on some different charts where it happens, and then we'll wrap this up. So I appreciate you guys learning with me today. I want to show you a few more places where this has occurred so you can see it happening on charts, see it happening all the time. Okay. So let's look for some more of these patterns. Okay. And here we are. Okay, this is Apple. It's an Apple chart. Okay. And if you come down, come down. All right, here we are. Okay, so we got the soldier happening here. excuse my mouse, trying to get my mouse to show up on the screen. Okay, so we get the soldier to show up here. Okay, all right, higher highs, you see that, higher lows, you see that, downward trend here. Okay, this I will say you want this green one to be a little bit higher, but it's like lined up symmetrically. So, I'll give this a go, but honestly, you want this green one to be a little bit higher than the high of this red one, but it's pretty close. All right, it's pretty close to what we'll be looking for in the soldier pattern. So you spot that soldier pattern happening here. Okay, it's happening here at the Bollinger Bandwidth. All right, so we know that it's at support, so there should be a reversal. Okay, then we take a look at our moving averages. The blue is above the green, is above the pink. So that's the 50, above the 100, above the 200. So we've got the fan going on. So we know the stock's in an uptrend. All right. So we know that it should be moving upward, which is great because we've got this one white soldier that says the same thing, that's going to be moving upward. And then we've got this Bollinger Band telling us the same thing, that it's going to be moving upward because it's at support. And we trail down here. And where do we find the stock? We find it near the 20. All right, so it's near that overbought, that oversold territory. It's near that oversold territory, bouncing right off the 20. So we know that it's near that oversold territory, and we find that it actually, ends up moving up. We go down here, we take a look at our MACD, and we could note on the MAC there isn't, there. If you look right at the MAC at that moment, there isn't a cross happening right then, but if you take a look at the histogram, we are reaching a bottom. We are at the bottom. This histogram is lower than all of the other histograms. This bar of this histogram is lower than all of the bars of the histogram, of the yellow that it's a part of. And so we catch it right here at the bottom. We catch that slope, and boom, the price goes up. Right? And we see it happen here as well. So that's everything that we're looking for. You take a look at the Bollinger Bands, but again, the bandwidth isn't so important unless there's a squeeze happening. Unless you see those Bollinger Bands getting close together, the bandwidth lacks power in terms of determining whether there's going to be movement in either direction. But the MACD is in your favor. All right, you're at the low. You're at the bottom of the histogram. The full stochastic is in your favor. You're at the bottom of the stochastic. The Bollinger Band in your favor. The candlesticks are bouncing off of the Bollinger Band right here at this dynamic support level. The candlestick pattern is in your favor. All right, there's the soldier happening for you right there at the support level. All things are symmetrical. There's confluence, there's congruence. It all looks great. You take the trade, you think the price is going up, you make a call option trade, and it does. The price goes up significantly, and now your account is full of cash. All right. So let's take one more look, and then we are out of here. Let's look for one more. All right, this is Cigna. This is a Cigna chart, and I am looking for a pin bar, and I think I've spotted him. Okay, so this is the pin bar, and you see it has that very small body. See, it has almost no lower wick, and you see that it has that very long upper wick. All right, and you note that there is all of this upward momentum prior to seeing it, the price of the stock moving up significantly, and then finishing off with that pin bar. So now let's travel down to see if there's some confirmation. So we see it bouncing off of the Bollinger Band. So that's great. We take a look over at our moving averages. We see that the 50s above the 100 and another 100 above the 200. So we know that it's in an uptrend. It's valid. All right. So we're hopping in it. We're good to go on that end. All right. And here's our pin bar. And we look down following it down. And what do you got? You got overbought territory in the stochastic. Another great sign that there is going to be a reversal. There's going to be a reversal. That's what we see here. Okay. And then we come down here to the MACD to look for some confirmation. And what do we find? So it's about here where it was. Let me just just annotate this. Stock Charts has an annotation tool that allow you to just draw lines. It's really helpful. So we'll just use that. All right, so now let's scroll down to see where it is, okay? So here's the bar. You note that the bar, this is the top bar, all right? This is the top bar. It's the top bar in this histogram. This is the top of this histogram before there's that slope. So everything lines up perfectly for us. You wouldn't have known this is the top bar until that next day, which is fine because that just gives you confirmation. But that's it. That's the slope that we're looking for. That's where we want to be. This is where we want to get in. All right. So we hop in here based on the histogram and the price goes down. All right. So everything is lined up perfectly. All right. And that's what you look for when you're making your trades. All right. That's how you determine if you want to go with a call, meaning that you think the price is going to rise, or with the put, meaning that you think the price is going to go down. All right. So I'm John Lyons. This has been the Iverson Options Trading Forum technical analysis course. I hope that you enjoyed it. I'm going to leave it up for days so that you can look it over again and again and again. If you got any questions, you feel free to message me or ask the questions in the group so that I can answer them. Hope I didn't leave out anything. But again, I am taking questions to clarify anything and everything for students. So please hit me with all the questions that you have. All right, guys, I'm going to be leaving this up for a while. Next week, we will do our next course on market sentiment, where you'll learn how to determine what's going on in the broader market. You know, if it's a good time for you to get in, you know, if you should be getting into the upside, to the downside, what are the big guys doing? We'll talk about all of that. All right. So thank you very much for your time. And I hope that this was informative. I'll see you again soon. All right. Have a good one.